The NASDAQ closed at a fresh record high around heading towards the 24K with broad strength across tech, communication stocks. And this is, of course, the image across the board. Equity indexes around the world are trading at record highs following the July CPI report from the US, which was the main catalyst. Of course, it rose 0.2 month on month, but which was in line with expectations, but a slowdown from the previous month. Year on year, it came though at 2.7, which was below 2.8 expected. And the core CPI, which excludes the volatile items of food and energy, was up on a monthly basis, but matched expectations. And year was a little bit hotter. But despite the firmer core, the takeaway was that inflation remains manageable. Okay, 10 basis points up or down, but they're not really ticking the bump, if that makes sense, right? They're not really get the bump to start ticking, especially with the labor market showing signs of cooling. So that kept hopes of a September cut to around actually they went up to 96%. And this is the main reason we see actually Nasdaq another high risk or beta risk, let's say, assets moving to the upside. That was from 86 just a day ago, to be honest, just before the CPI report. The thing is that a very interesting thing is that now October rate cut odds also soared to 64% from just 55, as well as December crossed above the 50% from 45 to 54%. So what we are currently seeing is that the markets are starting to price in 3 interest rate cuts for the rest of the year versus 2. Okay. Importantly, following the release, US Secretary Scott Bessent also called openly for a 50 basis point rate cut in September. Okay, so it's going to be important to see how this is going to play out. Of course, the things to watch for us, because we saw an uptick in core goods and services inflation within the components of CPI. We need to pay attention to those because we need to ensure that they're not going to challenge the new, more dovish narrative. Okay, now the support level here remains the 2373, which was the record high achieved back on at the end of July. Double top, very short pullback, and move to the upside. Now, one could consider this in the short term, of course, although it doesn't really have a U shape. It could be considered as a cup and handle in the short term, right? Typically, when this happens, okay, what we have to do is we have to get the distance from the bottom to the top, right? We could, for example, use, let's say, the Fibonacci extension here, right? And we are looking for the measured move target. Okay, the measured move would be the 100%, which brings us up to around 2478 in case, of course, this continues and no bearish catalysts suddenly start flooding the markets, right? We do have, of course, in the next couple of weeks, the NVIDIA earnings report, which is going to be very important. This is going to be probably a make it or break it situation. And, it will tell us in the next 2 weeks, of course, that is, if this rally is going to continue for the rest of the summer, perhaps even for the rest of the year. Other things are at play. Don't forget, NASDAQ is very, very sensitive, okay, especially with, given the sensitivity or the weight it receives from tech companies, right? The thing is that though the AI, cloud, infrastructure, and stocks are not expected to slow down at any point. Now, we did, of course, mention that level to the upside around 2450, 2470, but I also wanted to show you something a little bit more in the longer term, right? Let's just quickly take these drawings out. I want to show you a very interesting pattern here that could potentially be giving us another level to take into account to the upside, right? And the right thing would be to do this because this is a new peak, but since we've already broken above that level, still to consider, we would prefer to just go and drag that level connecting these two peaks. So this is considered um, an open, broadening triangle, if you may, or it could be considered any other different pattern. It shows us two things. On the one hand, that there is a little bit more room to the upside indeed, okay, and prices could accelerate up to, well, really depends on how fast they're going to go up and how long it will take, right? So it could essentially go up to 24.50 and perhaps higher, but it's a likely scenario that this could potentially offer resistance. And I wouldn't just say simple resistance, I would say probably it will be quite of a test of that resistance. Depends, of course, again, on when it's going to be hit. The long term count, though, guys, to the upside over here also kind of looks like bias to the upside. This is a very clear impulse to the upside. Um, but it looks like also again to me that this could potentially be an extension because typically we have waves 1 and 2 that looks like the 3 and the 4, and that potentially could be the fifth wave to the upside, right? And internally, we do have something like 1, 2, and 3 and 4, and we might get that move to the upside. That means that we can also use the Fibonacci tool again to between the waves 1, 2, 3, and 4, supposedly, if we assume that's the one case. The 61.8 is currently here, right? So I wouldn't be surprised if we get a short-term pullback. But again, the 78.6 and the 100 again give us the 24.75. 24.75 becomes a level. So of course that 24 will struggle first. So maybe a pullback first to the 24K and then perhaps a move up to 24.75. On the RSI, we see some sort of flatness, but no divergence as of yet in the longer term. We do have, of course, a divergence in the shorter term, which just to pinpoint here for you, over here we see higher prices, and over here we see slowing momentum. Okay, but again, if you notice at these two different points, okay, we also had a bullish hidden divergence on the RSI that was and probably is still what is pushing prices to the upside. So consolidation, pullback, continuation up until we hit that trend line are all at play, and it would be possible. Of course, they all depend on how this new, more dovish narrative following the CPI report is going to to be sustained. How long for? And importantly, now I think it's going to be a case where the Fed starts shifting towards the jobs data and unemployment specifically, because inflation seems to be like not the focus any longer, since it's not really getting hot any longer. So important to see the next piece of data as well.